U.S. nat gas futures slipped below $4 as expectations of warmer weather and robust production offset the impact of strong LNG exports and tight storage. Milder temperatures are projected through March 12, curbing demand for heating in homes and businesses. Meanwhile, February production remains near record highs, recovering to 104.3 billion cubic feet per day by February 25 after dipping to 100.5 billion cubic feet per day on February 19 due to well freeze-offs. Adding to the bearish outlook, an important geopolitical development unfolded today as Qatar and Russia's Prime Minister and Minister of Foreign Affairs held a meeting, emphasizing their shared commitment to continued cooperation in gas exports. This alignment between two of the world's largest natural gas suppliers could exert further downward pressure on prices in the near future, as stronger coordination in exports may impact global supply dynamics and sentiment in the market. As a result, European natural gas prices extended their decline on Wednesday, dropping 5% to €41. Additionally, the recent cold snap has subsided, giving way to milder weather across the region, further dampening consumption. Meanwhile, renewed optimism surrounding potential Russia-Ukraine peace talks is adding to the bearish momentum, contributing to the continued downward pressure on prices. From this perspective, U.S. natural gas prices seem to be teetering on the edge of a potential downturn. This situation reminds me of the 2022 scenario, in which a sharp decline in European gas prices triggered a steep drop in U.S. prices. Nevertheless, I don't anticipate prices dropping below $2.50 as they did in 2023. However, a retreat toward the $3 level appears quite plausible. The key difference this time is the continued growth in LNG exports, which should provide a floor for prices and help prevent a prolonged decline below the threshold. With global LNG demand remaining strong and export capacity expanding, any sharp downturn may be cushioned, limiting the extent of further losses. Also, be sure to keep a close watch on Thursday's storage report. While it may initially appear highly bullish, the market reaction could tell a different story. If the actual reported withdrawal falls short of speculative traders' expectations, it could lead to further downside pressure on prices. In a market driven as much by sentiment as by fundamentals, even a seemingly strong report can backfire if traders were anticipating an even larger draw. This dynamic has played out before, and if history is any guide, disappointment and fading weather-driven demand could spark another wave of selling. From a technical perspective, a bearish signal has emerged as prices slipped below the $4 pivot. If selling pressure intensifies, the next downside target could be $3.75, where additional support of a 50-day moving average may come into play. A comparable pattern emerged in January when prices briefly rebounded from the $3.70 level, only to experience a rapid and steep decline just a week later, ultimately testing the $3 support. Overall, sentiment appears to be shifting rapidly from bullish to bearish, with price action reflecting growing downside risks. Could natural gas prices extend their decline and test $3 in the near future? Drop your thoughts in the comments below. Please like, subscribe, and comment to support the channel. See you in the next one.